Hi folks, this is Rajat Bose from Kolkata. I'm just coming up with my new YouTube channel. What I could not say on television, I would be presenting that here. So if you like what I present, then please press the like button and subscribe to my channel. On Friday, the RBI has announced its bi-monthly monetary policy, and its stance has been fairly hawkish. Although RBI raised the repo rate by only 50 bips, which was already anticipated, but what was not anticipated was the hawkish stance, and that was emphasized through their withdrawal of accommodation. And the RBI governor, not just during the speech but also in the press conference later, emphasized the fact that RBI is very focused on price stability and inflation control, and he has also hinted that RBI would slowly take the inflation down to their target is actually the mandated 4%, but prior to that initially they are targeting at 5%, and the governor and the deputy governors have emphasized that the withdrawal of accommodation is going to be a top priority. What does that withdrawal of accommodation mean for the economy, for the stock market? Withdrawal of accommodation basically means quantitative tightening. That is, during the COVID, when RBI and other central banks have actually done a lot of accommodation in the sense that they sloshed the system with a lot of money. That money in India was ran into more than 10 lakh crores, but this time the number is actually coming down. RBI has already taken away a lot of that money back, and they are still continuing to do so, and they have said that they are going to do it in a big way. So this is definitely something pretty much hawkish, because any bull run for its sustenance requires a lot of money to be around, so that people have money to buy stocks and other things, and generally price appreciation happens in a much better fashion when there is money sloshing in the system, and now the opposite thing is likely to happen. Apart from that, that the RBI is not in a mood to accommodate the no more rate hikes or something, or that kind of an easy money policy is actually a thing of the past, at least for the time being. The RBI said that the capacity utilization figure is pretty much high, and that capacity utilization figure seems to be very much high. It indicates that the economy is already performing pretty well despite the recent rate hikes. So RBI is in no mood to actually accommodate the asset markets, the equity markets. So there are chances that there would be more such money withdrawal. As of now, according to the governor, there had more than 5 lakh crore money that is in the SDF system. More than 5 lakh crore money is still floating around, and that is quite adequate, or rather more than adequate. So what I am trying to tell you is this, that in an environment where not only interest rates are getting hiked, this quantitative tightening, that means withdrawal of the money that was circulated during the COVID period in order to boost the economy, in order to help the economy continue on a growth path, that growth is very much there now. Now to RBI's top priority is inflation control, and if inflation control means withdrawal of money, then it would actually affect all asset prices, bonds as well as equities. So point is this, that this kind of a situation means that now people would be very choosy, and people would have to be very choosy. They will have to actually buy stocks that have got good dividend yield, that have got good fundamentals, that produces good free cash flows. That kind of stocks are likely to sustain. Otherwise, what is likely to happen is that lot of story based stocks, lot of stocks where you do not have the fundamental performance, those kind of stocks are likely to suffer. Stocks that are already very highly valued, they are discounting say FY26, FY25 earnings, those kind of stocks are now going to suffer selling pressure. So we need to be very choosy. At this point in time, what I would suggest is that we have already seen an uptrend, and this uptrend since October 2021, this is the third intermediate uptrend, and this uptrend is very significant in the sense that it has lasted for already 48 days, counting up to the Thursday when actually it posted the high of 17,490, and this is a 2307, that is 2,307 point upswing. If that 17,490 is not breached in this week, in that case this is the longest uptrend, and as well as this is the second largest uptrend in terms of price amplitude. So this definitely augurs well for the bulls, but considering the monetary environment, considering the interest rate environment, I consider that it's not the first leg of a bull market. It is a bear market rally, and it should be recognized as such. Of course, there had been stocks that have given real good upswing and they are showing strength, but chances are that we are probably heading into a correction. Maybe this week, anytime this week, that correction might actually begin, because mostly if you look at the stocks that are in the futures F&O segment, most of them are giving signals of a correction. Some of them, like some banking stocks, some IT stocks and some cement stocks, are showing some strength. Otherwise, the things are not at all hunky-dory. Now let us take a break, and after that we would actually discuss the indices as well as some stocks and how they look for the next week. Hi folks, this is Rajat Bose from Kolkata. I'm just coming up with my new YouTube channel. What I could not say on television, I would be presenting that here. So if you like what I present, then please press the like button and subscribe to my channel. This week the Nifty has actually closed at 17,397. This is the best uptrend we have had since October 2021. After that there had been three intermediate uptrends, but this is the longest uptrend in terms of time, that it has already elapsed 48 days and 2307 point the price amplitude is. But what it looks like is that now there are signs that this uptrend is actually sort of petering out, and chances are that it would seek some correction. There is a possibility of a correction there. The first support that we would actually keep an eye on would be 17,150. If 17,150 range is broken, then the next target would be something like 16,800. There is a possibility that the correction might at least take the Nifty down to about 16,500. That is the possibility that we can look at. Of course, if the Nifty were to actually scale up beyond 17,600 and sustain above that, then there is a possibility that 18,000 might well be scaled up. But the further it goes, the greater will be the probability of a corrective swing. So the thing is that the major indices, that is the BankNifty as well as the CNX mid-cap Nifty, all these are suggesting that there is every possibility that we are likely to see a correction. This is the BankNifty chart, and you can see that the kind of movement that has happened. Bank Nifty is also suggesting that there is an initial target of 37,480. That is the basic minimal correction that we would be watching for. If 37,480 gets taken out, then only you would find that the Bank Nifty becomes weak and it could fall. Actually, Bank Nifty might give a little more, might get a little more sustenance, because the major banks like ICICI Bank and other banks are also not looking as bad compared to the other segments of the market. So that being that, Bank Nifty can also come down, because there are other banks like HDFC Bank that is looking weak, and even some of the PSU banks like State Bank, Bank of Baroda, then there is Kotak Bank. All these are suggesting a possibility of a downside correction ripening. Even the mid cap index is actually giving a signal that the mid cap index might well correct, because as you can see on the chart, if the mid cap index were to fall below 29,925 levels, today on last Friday it closed at 13,258, and the level that we need to watch out for would be 29,925. If this level is taken out on the downside, then there is a possibility that even the mid cap index is likely to come down. What is the target? Initial target would be something like 28,860, and after that there is a major support for the mid cap index at 28,330. 28,330 if broken, then only there will be further selling, but otherwise at least that kind of a correction seems a little overdue. So possibility has it that we would see a corrective swing, because most of the stocks, a number of large stocks are actually showing possibilities of a correction. Some stocks have already entered into a correction. Among the stocks that are looking pretty weak are Britannia, Gas Authority, Hindalco. These are stocks that are pretty much weak, and they might actually fall further. Even IEX, that is India Energy Exchange, and IRCTC, they also might go in for some kind of a correction. On the other hand, there are stocks that are looking pretty much bright, like ICICI Bank. ICICI Bank looks quite strong. This ICICI Bank stock might actually move from here. If you now look at the chart of ICICI Bank, what you find here is that this is the best bank stock chart, and it is actually trying to cross the major resistance zone, that is between 850 and 875. If ICICI Bank manages to get past that, then there will be further rally in this, and till such time the ICICI Bank stock doesn't fall below say 810, ICICI Bank would continue to remain bullish. This is the best banking stock. Like for instance, you have in IT stocks like Wipro and Mindtree, Infosys. They are looking pretty good. Even they can actually move on the upside. Their corrections are due, but they may not correct so easily. On the other hand, there is every possibility that you might see stock like Hindalco might fall. Even Vedanta could be coming for some pressure. Otherwise, Tata Steel among metals is still looking good. So these are the stocks that you should keep watch out. You should be watching for. I mean, on the upside, cement stocks like Ultratech, cement stock like Ramco Cement. Ultratech and Ramco Cement, you can see from the chart that Ultratech is already on a very strong uptrend, and unless it falls below its 200-day moving average at 6435, Ultratech might actually continue to move up. And although there is some resistance around 7,000, Ultratech can still move up. That is the possibility. Similarly, in the cement space, Ramco Cement, of course, it has similarly Ramco Cement, which of course has not really crossed its 200-day moving average, 200-day exponential moving average. Ramco Cement, once it crosses the 200-day moving average, that is around say 780, and then there is some psychological resistance around 800. So 780 to 800 range, if taken out by the Ramco Cement, then there is every possibility that it would continue. So what we see is that sectorally, some of the sectors like cement, like IT, like like banking stocks, they are still looking good. Maybe a pharmaceutical company like Divi's Lab might be looking good, but most of the stocks are actually showing chances of a correction. Hi folks, this is Rajat Bose from Kolkata. I'm just coming up with my new YouTube channel. What I could not say on television, I would be presenting that here. So if you like what I present, then please press the like button and subscribe to my channel.